Chapter 12, the loan and the consumer. So the first thing that we have here is Regulation Z. Regulation Z is all about the Truth in Lending Act from 1969. And here's what it says. Look, if you are going to loan somebody money, you have got to tell them, you have to disclose to them exactly how much the cost of borrowing that money is going to be. Because even though you might get a low percentage rate, when you look at it over a long period of time, you're still going to be paying a lot of money to the lender. So Regulation Z says you have to disclose exactly how much it is. Whenever you go to a closing, you have a stack of papers that you have to sign that's like 3 inches thick. Sometimes, I'm not exaggerating. And so there's one sheet of paper in there, and the attorney always looks at it and says, don't look at this number, right? Because it shows you exactly the amount of interest that you're going to pay over the life of the loan. And they're like, wait, don't look at that. But the truth is that because of the Truth in Lending Act, they have to disclose that to you. Have you guys ever heard one of those ads on the radio where it's like a car dealer ad, right? And at the very end, they have someone talking really, really, really fast, and they're talking about how many payments you're going to make and what the interest is going to be and all that kind of stuff. Regulation Z is the reason for that. If they say anything about the number of payments, your down payment, the finance charge, if they say anything about any of those topics, they have to disclose everything about the loan. So whenever you hear someone talking really fast, whether it's on a television ad for a car or whether it's on a radio ad, when you hear that at the end, that's them trying to comply with Regulation Z. And if you don't comply with Regulation Z, you can get fines. So people make sure that they're definitely complying there. And by the way, if you don't comply with Regulation Z, it's $10,000 a day for violation. So that's the reason why people are really paying attention to that. Now on this slide here, we're talking about the Dodd-Frank Wall Street Reform and Consumer Protection Act. So this was passed in 2010, and it was passed after the housing crisis. And basically it just created new financial regulations. They said, look, banks, you have to do things a certain way, and if you don't, we're actually going to penalize you for it, whereas before there were no penalties. So banks could actually get fined if they don't do things a certain way. So the compliance standards actually began in October the 3rd of 2015 for new loan applications, and it's pretty much gone pretty smoothly since then. Now, we've talked a little bit before about the Truth in Lending Act, and we've also talked about RESPA, the Real Estate Settlement and Procedures Act. Now, what happened is that these two different acts were combined, and now they are what we call TRID. So it's combining Truth in Lending and Real Estate Settlement and Procedures, and basically what happened is they just changed a lot of terminology. So you have a lender who is now referred to as a creditor. We have a borrower who is now referred to as a consumer. Consummation is when the consumer becomes legally responsible for the loan, and settlement is when the loan becomes a lien on the property. One of the things that has shifted just a little bit is that the loan estimate has to be provided to the consumer within 3 days of them making an application. So basically you have to follow it fairly quickly. And the closing disclosure has to be provided no later than 3 days before consummation. So what this means is that you have to have the closing disclosure finished, and it has to be approved by the underwriter before you can actually close on the loan. So I have one of my mentees that I work with at EXP, and she had a loan closing last week, and they were going to try to close it early on the 11th, and originally it was planned for March the 16th. And she called me. I actually texted her on the 11th, and I was like, so how'd it go? And she goes, oh, well, it got pushed back because they didn't have the CD ready. And she's a brand new agent, so she said, what is the CD? And I said, well, that's the closing disclosure. So apparently they had intended to close it early, but were not able to do so. And so they had to push it back to the original closing date of the 16th. And then on the 16th, it closed and everything was fine. But that's what CD stands for, closing disclosure. So under TRID, whenever you are submitting a formal loan application, there are 6 different things that you have to have in the application. So you have to have the borrower's name, the monthly income. You have to have a social security number for the person borrowing, the property address, an estimate of the value of the property, an estimate of what market value would be, and then also the amount that you intend to borrow. So these are the 6 things that you have to have in order to submit a formal application. We've talked about interest rate a lot, but the truth is that interest rate is a really good gauge of how much you're going to pay for something, but at the same time, you also have to consider the fact that whenever you get a loan, there's other expenses that go along with it too. Like, for instance, at the bank, they're going to charge you a loan origination fee, and there's all these other little fees that get attached. And so you can talk about the interest rate all day, but if you're trying to compare different loans at different lenders, then it's really actually better to look at the APR. This is the annual percentage rate. The annual percentage rate combines all of the costs associated with the loan with the interest rate. So this is really a far superior way if you're comparing one loan to another in order to see exactly how much it's going to cost you over the long run. This is an example of comparing two different loans and looking at the annual percentage rate versus just looking at the interest rate. So first we have loan A, which is $200,000. It's a 30-year mortgage, both of them are. Loan A is at 6.5%, and the upfront fees are 1.5%, and the upfront mortgage insurance fee is 1%. If you look at loan B, $200,000 yet again, 30 years, the interest rate is a little bit less, so it's 6.25. So if you're just looking at the interest rate, you're going to choose loan B. But then look at the loan fee or the upfront fee for loan B. It's 4%, whereas with loan A, it's only 1.5. So if you look at just that, you're going to choose A. And then the upfront mortgage insurance fee is the same. So the annual percentage rate is going to give you a better idea by comparing two different loans to each other, which one is actually going to be cheaper for you. So when you look at this, loan B is actually just a little bit cheaper than loan A. This is an interesting topic. This is the right to rescission. And I think a lot of people don't really know about this, but this is the borrower's right to cancel a credit transaction under the Truth in Lending Act. You actually have 3 business days after signing to back out. This does include Saturdays. This applies to home equity loans, lines of credit. It also applies to refinances. Keep in mind, though, it does not apply for credit that you're using for your principal dwelling, the house that you live in all the time, or construction of a property. So if you're buying a house that you plan to live in, if you're building a house that you plan to live in, it doesn't apply to that, but it does apply to home equity loans, lines of credit, and refinancing. So you do have 3 days to back out if it applies to any of those things. Let's talk a little bit here about the loan process. Lenders qualify the borrower, and that's what we're going to talk about over the next few slides. Now, they also qualify the property. How do they do that? We've already talked about this topic. They do that through an appraisal, right? So we're going to figure out what the market value of the property is. The lenders also qualify the title. The title is qualified through a title search. So how do they qualify the borrower? There's lots of different things that they look at, and that's what we're going to talk about next. Okay, so qualifying for a loan here. There's lots of things that lenders look at. The first is going to be settlement funds. Where is the money coming from that you're using to buy this house? I mean, hopefully you're going to have a really nice down payment. How much money is in your checking account? How much money is in your savings account? Is the money that you're using to buy the property coming from the sale of another property? If that's the case, then they want to know what the status is on that other property. Are you a week out from closing? Are you 2 weeks away from closing? Have you even gotten a contract on the house that you're intending to use the proceeds for to qualify for this property? So they're looking at lots of different things. Also, the purpose of the loan. They want to know, what kind of loan is this for you? Is it for a residential property? Are you buying investment property? Is it a house that you intend to rent? That kind of thing. They also look at your monthly income. So how much money do you have coming in? What is the exact amount? Do you have monthly income that comes in from different sources? Do you have multiple jobs? Do you have rental income that comes in from rental properties that you have? So what's going on with your monthly income? They also look at your assets and your liabilities. They want to know too, how liquid are your assets? You know, when you talk about stocks and bonds, you can sell them fairly easily, right? So they're very liquid. When you talk about houses, however, that's not a very liquid asset, because even if you list a house today, it's going to take you a little while to get it sold. Even if you find someone who's going to pay cash for it, it's still going to take a couple of weeks to get it done. If you have someone that's getting a loan, it's going to take 30 to 45 days if you get a contract the day that you list it. So housing typically is not a very liquid asset. They also want to see what your liabilities are. So what's your debt? What do you owe, right? How many liabilities do you have? Do you have a lot of credit card debt? Do you have a large house payment? Do you have an extra house payment? Do you have to pay alimony? Do you have to pay child support? What are your specific liabilities? They also look at credit references. A good example of this would be if you are renting and you're planning to buy for the first time. They will probably call your landlord and say, hey, does this person pay on time? We also have loan to value ratios. There are specific ratios that lenders look for in order for you to qualify for a loan. So how much will you put down on the property? And that's also going to indicate what your insurance is going to be on the property, if you have to pay it or not, with regards to conventional mortgages or FHA mortgages. Remember MIP and PMI. They also look at your credit report. Okay, so let's talk a little bit more about your credit report. So these are the documents that you're going to need to provide to the lender in order to get the process going to qualify for a loan. So you have to have your driver's license or a photo ID, your current pay stub with year-to-date income. They want to see 2 months at least of your current bank statements. They're going to ask for W-2s, 1099s for the past 2 years. They're going to look at your tax returns for the past 2 years. And if you haven't filed your taxes by April the 15th, then they're going to need to see that you have an extension filed for October. So they're making sure that you're paying everything when you're supposed to and you have documentation of all the money that you have coming in. Your credit report. This is a document that the lender is going to use, and it's going to help them to determine whether or not you're a good credit risk. One of the things I wanted to mention here is the Fair Credit Reporting Act. And this is important because it allows you as a consumer to view your credit report to make sure that there's no issues, make sure there's no errors or anything that needs to be corrected. So you have a right to view your report. Credit scoring. This is the method that we use to evaluate how risky someone is, okay, with regards to their credit. Now, there are 3 major credit bureaus. We have Equifax, we have Experian, and we have TransUnion. So each of these 3 is going to provide you with a score. Sometimes the scores are very similar to one another. Sometimes they can vary significantly, and that tends to happen more if your credit's not great. But those are the 3 credit bureaus. So let's talk about your FICO score. Do you know what your FICO score is? If you do not, that's part of your homework for today. Figure that out. Go to creditkarma.com. It really is free. But figure out what your credit score is. You need to know what it is. Your credit score is provided by the Fair Isaac Corporation, and that's actually where FICO comes from, Fair Isaac Corporation. It can range anywhere from 300 to 850, and it's based on all the information that they look at in your credit report. So the score is what lenders use to figure out how risky you are as a potential borrower with their company. Obviously, the higher the score, the lower the risk for them, and the lower the score, the higher the risk for the lender. Now, it says here that the average U.S. credit score is 678. That's actually old. I looked it up, and for last year, it was 698. So it's gone up significantly, which I was actually surprised by. So let's talk a little bit about how they determine your credit score. So how is your FICO score determined? There are 5 different categories that go into your credit rating. So let's look at what they are. The first one is going to be your payment history. That is 35% of the rating. Guys, listen, there is no excuse for this. You can auto pay everything online these days. So making sure that you make your payments on time is so important. That's 35% of your score. That's the highest percentage of any of these 5 categories. So your payment history, making sure that you're paying all of your bills on time, super, super important. The second one here is the duration of your credit history. That is 15%, okay? There's nothing that you guys can do about that because most of you are very young, so you haven't had a credit history for very long, okay? So just sit tight. You'll eventually get there. The amount of new credit counts for 10%. So be careful about applying for all of those brand new credit cards at all of these different retailers. You don't really need all of that, and I'm going to talk about that later. But that does count for 10%. So whenever you apply for a new credit card, that's going to be considered in your score. They also look for a healthy mix of credit. Okay, this is 10% of your score. A healthy mix of credit is going to involve different types of credit. So the first one I want to talk about is revolving credit. Revolving credit is like a credit card. You don't have to pay the full balance, but you have to pay a minimum payment. And then whatever is left over rolls to the next month. Revolving, right? You don't have to pay the thing in full every single month. You just have to make a minimum payment, although I would not recommend that. We also have installment credit. So what do you think installment credit might be? Installment credit is like a car loan. You pay exactly the same amount every month until it's paid in full. Okay? So we have revolving credit like credit cards. We have installment credit like a car loan or a truck loan or rent, right? Because you're paying the same amount every month. So they want to see that you can manage both types of credit, and if you can manage both types, then that's going to increase your score. The last category here is the debt that you have. So the debt that you have counts for 30% of your credit score. How much debt do you have? If you don't have any debt, or if you have just a little bit of debt, that's going to increase your score. If you have a lot of debt, that's bad. Okay. One of the interesting things about this slide is it says at the very top, income is not a factor in determining FICO. You could literally have an income of $25,000 a year and you could have an excellent FICO score. You could make $2 million a year and you could have a terrible FICO score. So your income actually has nothing to do with it. It's all about those categories that I mentioned in the previous slide. What does your payment history look like? How long have you had credit? Are you applying for a lot of new cards? All of those types of things, right? So that's actually what is so important. Now, there are several major factors that can affect your score. Your level of revolving debt is significant. So let's talk a little bit about that. Whenever they're determining your score, they look at the amount of credit that has been extended to you versus the amount of it that you're actually using. So let's say, for instance, you have a credit card that has a $1,000 balance on it, and you have used up $999 of that. Okay, that is going to negatively affect your score, obviously. Okay, if you've only used $100 of the $1,000 that has been given to you, then that is going to increase your credit score because it shows that even though you've been extended credit, you don't have to use it all, right? So they look at the difference between the amount of credit that has been extended to you from different creditors versus how much of it you're actually using. Now, a lot of people say that if you have a credit card, say with a $1,000 balance, you should stick to just a third of that to charge up, right? So you're around, a little over $300. So if you stick to that idea, then you're going to have a higher score because you're not using all of the credit that has been extended. Another thing here is shifting balances. There have been times where credit was so available that you would get credit card offers in the mail all the time for 0% interest for 18 months, for instance. And you might have someone who had a lot of debt on a credit card, and so they would shift the balance to another card. That's going to negatively affect you if you do that a lot. Now, I will say this, there are some circumstances, particularly if you are trying to pay off debt where you have credit cards that have high interest rates, where you can shift a balance to a 0% card and use that time frame that they give you to actually pay it off. So sometimes shifting a balance is beneficial, particularly if you're trying to pay off debt. The length of time your accounts have been established is going to be beneficial to you the longer you've had the account. So there again, there's really not a whole lot you guys can do about that except wait. If you have too many accounts with balances, that is going to negatively affect you. The truth is you don't need a whole bunch of credit cards. You might need one, maybe two, and that's really it. You don't need a whole bunch of them. Another thing too is too many credit inquiries within the last 12 months. If you've had a lot of inquiries on your credit, that is going to decrease your score. So be careful. If you're going to go out and buy a car or a truck, wait until you get to the dealership where you know you're going to buy before you have them run your credit, because that is going to negatively affect your score from anywhere from 3 to 6 months. It's going to drop your score. So go in there, act like you know what you're doing, right? Tell them, I checked my credit yesterday. My credit score is 756, so I don't need you to check it. What kind of deal can you give me on this car, right? Act like you know what you're doing. And then when you're at the dealership where you know you're going to purchase, then let them run your credit. This is just an example of how your FICO score can affect the interest rate that you're quoted. If you're going to borrow anything, whether it's going to be for the purchase of a house or the purchase of a vehicle, or if you're financing furniture, which I don't recommend, by the way, pay cash for as much as you can. But if you're financing anything like that, the lower your score, the higher the interest rate you're going to be quoted, because you're more risky. So if people tell you that your credit score doesn't matter, that's not true. Your credit score is very important. The higher your score, the less you're going to pay for something over an extended period of time, something that you're financing. So if you don't have a great credit score, how can you improve it? One of the best ways to do it is to start paying all of your balances consistently and start paying them on time. If you are one of those people who pays things late, set it up on your calendar, get an alert on your phone, make sure that you pay everything on time. You can actually set up most things where it's automatically drafted out of your account. So as long as you're getting paid, you can pay everything on time. Another thing is to reduce your outstanding balances. If you're trying to pay down debt, then put as much money towards paying off outstanding balances as you can, because remember, they look at the difference between the amount of credit extended to you versus the amount that you're actually using. So if you're reducing your balances, that is going to increase your score. Another thing here is pay off your debt rather than shifting it to other credit cards. You can actually shift a balance on a credit card to a new promotional offer on a new credit card, and basically what you're doing is you're putting off having to pay off what you already owe, and you're shifting it to another card where you can get maybe a 0% interest, like a promotional type deal. That's really not a good idea, because eventually you're going to have to pay it back. Another thing is all of those store branded cards where you get an immediate discount, don't apply for those. You don't need them. If you go to TJ Maxx, what do they say when you're at the checkout counter? Would you like to apply for a TJ Maxx credit card? You can save 10%. Well, I mean, most people when they go in there, they're spending, what, 35 bucks? How much is that really? $3.50? It's not worth it, because then what do you have? You've got this TJ Maxx credit card now, and it's Christmas time, and you forgot that you have to get a gift for Aunt Barbara, and you're going to use that card. And then you're going to have a date, and you're going to need a new outfit, and you're like, I don't have any more money, but I have my TJ Maxx card, and then you use it, right? So don't do that. You don't need all of those store branded credit cards. Just get you one good Visa that they can use. You can use it anywhere, and use that. You don't need all the store branded cards. Now, I will say this. There are some situations where applying for a store branded credit card does make sense. I've done this myself. A couple of years ago, we had to buy a washer and a dryer. So we went to Sears, and I got nice ones, right? And they had to match. So I was spending like $3,400 at Sears. And so when I got to the counter and they said, would you like to apply for a Sears card and save 10%? I'm like, yeah, I would. Because 10% of $3,400 is $340. That makes sense to me. Okay, so I applied for the card, was approved. I immediately went home and paid it off in full, and I've never used it since. Okay, so there are some situations where getting an immediate discount makes a lot of sense, because if you're saving hundreds of dollars, go for it, right? But if you're saving $350, I don't think I would go for that. If you don't need new credit cards, don't apply for them, because the more you have, right, the more likely you are to use them. And then the last thing here is don't cancel your oldest card or close accounts. A lot of people, particularly when they're paying off debt, they get super excited because they've paid off a card and then they want to cancel it. Don't do that. And here's why. Remember how I said they look at the difference between the amount of credit extended to you versus how much you're using, right? So if you have a card, $2,000 limit that you've paid off, don't cancel it, because now it looks like, oh, look, she's got $2,000 worth of credit extended to her that she's not using, right? So that's going to increase your score. Now, I will say this. There are some companies, if you do not use a card within a 1-year time frame, they may cancel the card on you. Most of the time, they don't just cancel it. They will send you a letter that says, you haven't used this card. Please use it by this date or we will cancel it on you. Now, you don't want them canceling your cards, right? Because that looks like a negative. So every once in a while, you might have a card where that happens. Just go and use it for fuel or buy a gift for someone and then pay it off, and then you're good, okay? So just be cautious of that sometimes there are cards, if you're not using them, that they will say something to you, but they will give you an opportunity to charge at least something, pay it off, and then you're probably good for another year. If you guys have any questions about credit, shoot me a message in email, Infolio. If you want to have a discussion about credit, I'm happy to open a discussion floor for that, because this is something that students typically have a lot of questions about, and it's a topic that a lot of people are interested in because it is very important and it will apply to you when you get out into your first real job in the world. So if you have additional questions about credit, please don't hesitate to reach out. I am very forthright when it comes to information about my own credit. I have charged credit cards up before. Yes, I did it. I was in college. I had to have new shoes. I had to have new outfits. I charged up a lot of money and I paid it all off. Okay, so I've done the wrong thing with regards to credit. I've learned how to fix it. So I know some of those little tricks that some people may not. So if you do have questions, please don't hesitate to reach out. So we've been talking about lenders, right? And there is something called the Equal Credit Opportunity Act of 1974. And what it does is it prohibits discrimination by lenders. So a lender cannot discriminate against someone because of their race, color, religion, national origin, sex, marital status, age, source of income. So these are the protected categories. I will say I had a lady that I was selling a house to. This was about 2 years ago, and she was separated from her husband. She was not divorced. She had qualified for everything. They had taken everything out of her name and his name together. And we were sending all the information to underwriting to get approved, and underwriting came back and said, oh, well, we can't give her this loan because she's still married. And I was like, excuse me, have you not heard of the Equal Credit Opportunity Act? You cannot discriminate because of someone's marital status. And the lender was like, oh, you're right, they can't. You got to keep people on their toes. Redlining is lenders refusing to make loans in certain areas. So this is typically due to low neighborhood quality, but today lenders can't simply refuse a loan because of the age of a house or the location of the property or the neighborhood. Maybe it's the income level or the racial or the ethnic or the religious composition of the area. They can't do that. You cannot discriminate based on the religious composition or the racial or ethnic people who live there. So redlining is prohibited. In the House of Cards documentary, you learned a lot about predatory lending and mortgage fraud. So predatory lending is when you have lenders that are basically taking advantage of borrowers because the borrowers don't have a whole lot of information about obtaining a home loan. People don't buy houses every day, and so a lot of people truly do depend on their lender to give them all the information that they need. And so sometimes people can be taken advantage of. That is an example of predatory lending. And then we have mortgage fraud. This typically involves conspiracies between, it could be the loan originator and the appraiser, it could be the buyer's broker, it could be a title company, the seller's agent. There's lots and lots of different ways that you can create mortgage fraud within a transaction, and Georgia is one of the leading states for mortgage fraud. So it's something that you have to look out for. Here we have several different examples of things that would be considered fraud. A buyer falsifying their identity, obviously, right? What about conspiring with appraisers to have the house appraised for a higher amount than what it's actually worth? That is mortgage fraud. If you have a buyer that is claiming that they're going to live in a house, but they actually plan to rent it out, that is fraud. What difference does it make, you say? Well, if you're buying a house and you intend to rent it out, you're going to get a different type of loan, and it's going to be a more expensive loan. So if you're trying to reduce the amount that you're paying, then you might say, oh yeah, I'm going to live there. And you don't really intend to. Another thing would be conspiring with home inspectors. Maybe you're falsifying information about the condition of the house so that the buyer will actually make repairs, or maybe they'll discount the price for you. So these are all examples of things that you can do that would be considered fraud. Here's another example of fraud. We have identity theft. So identity theft is the misuse of someone's identity, stealing someone's identity. And you probably know someone that this has happened to. There are 8 million Americans that are victimized annually. 200 million hours trying to recover losses. That's a lot of time. There was one man in New Jersey, and he was using other people's identities, and he stole $1.2 million from 2 mortgage lenders using someone else's identity. So people do it. It's crazy. So here we have the Patriot Act of 2001, and this was signed into law in response to 9/11. A lot of the terrorists were using false identities in order to get into the places where they shouldn't have been. And so as a result of that, we have the Patriot Act. And basically what they're asking financial institutions to do is to verify the identities of the people that they're doing business with. They're asking you for your name, your address, your date of birth, your tax ID number, or your social security number, a copy of a government-issued photo ID. The truth is, though, if someone wants to falsify all of that information, they can still do it. So you just have to be really, really careful as a lender. So here we have predatory lending. Subprime mortgages are explained here, and you should know all about them from House of Cards. So subprime mortgages are mortgages that were given to people who basically did not qualify for the loan to begin with. So an example would be a stated income loan where you just state how much money you make and you don't have to prove it, which is absolutely ridiculous, right? Hindsight's 20/20, but that should have made sense to begin with. People lied on loan applications in order to buy houses. They knew that they couldn't afford the houses. They knew that they couldn't afford the payments, but they were lying on the applications to get the houses anyway. And the reason that they were doing it is because they thought that the equity would increase enough so that they could refinance and pull money out. So subprime loans it was a big deal in the early 2000s. And luckily, most of the lenders today are way, way, way more cautious whenever they're giving out a loan. So if you're going to qualify for a loan, you have to highly qualify for it. They're not going to give a loan to just anybody like they were doing in the early 2000s.